Hello and welcome to Critical Line Item. My name's Tom Rablick. Thank you for joining me for this particular podcast. Now, we're in the midst of the coronavirus pandemic and in Melbourne, where um, my guests for this podcast tonight are, where we're all in lockdown. And one of the things that people may be thinking about is what in heaven's name do they do with their interest rates and their repayments on loans and other financial arrangements when we move out of the pandemic mode and into something that loosely resembles um, more of a regular pulse in terms of commerce. Um, we probably won't be there for a little while yet, but what happens in tax terms with interest payments and how does all that work? Because people are going to be worried about that. Lisa Gregg, who's a tax agent and a tax trainer and a tax advisor herself, uh, is with me to talk a bit more about that kind of thing. Lisa, thanks for joining me again.
Thanks very much for having me, Tom.
Absolutely, an absolute pleasure. And one of the issues that people are going to face as we go through this latter part of the pandemic is the issue of loans, loan repayments, and that kind of thing. So I thought it'd be useful for us to just explain to people in what circumstance those interest payments might be deductible for tax purposes because not everything is deductible as we've discussed before. Um, and in a period of stress, people may be wanting to get some clarity on what they're able to claim. Uh, what's the situation in terms of interest payments at the moment?
Yeah, thanks, Tom. Well, we really have to put it into two buckets because interest deductions are covered under the general deductible provisions of our tax act. So we've got two different types of deductions. We've got the general ones, and then we've got the specific deductions. Okay, so it's covered under the general deductions, and the way the general deductions work, it works differently whether you're an individual or whether you're carrying on a business. So individual, I'm saying, is actually like a salary and wage earner, for example, um, as opposed to carrying on a business. So we need to look at it in two different ways. And so if we have a look at it from an individual point of view, most of the time when we're talking about interest deductibility, so basically someone's taken out a loan for some money and they need to make a principal and interest repayment or just an interest repayment. For an individual, that's pretty much bookended by the lovely investment property, the beloved negative gearing, as we sometimes call it, and things like that. Okay, so that's sort of the first cab off the rank, if we want to talk about it like that,
It's
Tom,
it's
which
not
is
all- it's not
basically
yeah. Well, you've got there's two situations that are possible. One is I'm an individual. I borrowed money, my first home. Um, the interest payments on your first home aren't going to be tax deductible, right?
correct. Correct. So
Because your residence is not a property investment per se.
correct. So as we talked about with work related deductions and things like that in previous podcasts, there's got to be a nexus between or connection between the assessable income and claiming the deduction. So that's where it comes under this general deduction scheme. So where I'm talking about for an individual, if you're, and I was alluding to investment property, if you've got your primary place of residence, you've got a mortgage on that, the interest deductions are not deductible for tax purposes because you're not earning any income, let's say, from renting out that house. It's your primary place of residence. You do get some tax breaks because we've got the main residence exemption, which means that when you sell it, you don't have to pay any capital gains tax. Okay, so there's benefits that way. Okay, where if you've got an investment property where you're generating assessable income through renting out the premises, okay, if you sell the property, there's a capital gains tax component, but also if you've taken out a mortgage specifically for purchasing of that property, then the interest is deductible.
Okay. So that for the listeners is uh, the interesting bit. If it's your residence, you're not using it for rental purposes. That is, it's not an investment property. It's the thing you live in. The interest that you incur on the loan or the mortgage is not deductible. If you're doing the property investment thing and you're playing property tycoon, then there's a deductibility there in terms of the business you're running as a property owner, and some renting things out and whatever have you. Now that let's set the individuals aside for the moment.
Oh, can I just add one more thing on that, Tom? Because I think it's important to note that the banks or the lenders have got very sophisticated different products that they offer to investment properties. And so what the listeners have to be careful about with the deductibility is things like, is there an offset account that offsets the rent for that mortgage or loan? Or is there a redraw facility or whatever? So you've got to be really careful whether all the amount is deductible for interest purposes, for deductibility purposes. Okay, so you've got to look at that. Where a lot of issues arise, and the ATO are heavily auditing this area, is that you've got a loan for say $500,000 on your investment property, then you decide you're going to go and buy a Tesla car, or you're going to do a renovation on your primary place of residence, and so that $500,000 mortgage then goes to $700,000 or something like that, right? That $200,000 that you've used for private purpose, the interest on that is deductible, even though there's a connection with that investment property. Okay, so we've got to look at the different ways that the lenders structure these products, and a lot of it's to do with redraw and an offset. So you've just got to be mindful about how it's structured, and talk to your tax agent and to work out what's deductible or not. To just be mindful. So if you're looking at purchasing a property, say if you're in lockdown Melbourne and you're about to purchase a property in the Gold Coast, Brisbane, because you want to escape, uh, for of course for the good weather more than anything else, let alone stage 4 lockdown. What you want to do is talk to your tax agent before you go about getting that loan, to work out what's going to be structured best if that property on the Goldie is going to be an investment property.
You've actually raised several important issues there, but I want to highlight one that I will be ranting on a lot about when Rorts and Ripoffs, my next book, comes out, and that is if you're having a discussion with your bank about financial products, remember that somewhere along the line in that banking sphere, people are getting some kind of, or will be getting some kind of reward for, getting you to buy that thing. uh, it's important that people seek some independent advice, have a conversation with another professional before they commit to a particular financial product that looks somewhat enticing. Uh,
Oh,
it's
exactly,
important.
Tom. And I've
It
and
is
I've
important.
Yeah, sorry, I've got a lot of clients at the moment that are refinancing for some reason, and I always say to them, they go through a mortgage broker or something like that, and go, well, they're suggesting the four products that they're probably getting very nice little commissions or trailing commissions from. So ask the question. You've got to be upfront with, are they recommending the best product for you, or are they recommending the best product for them? So it's always good to ask the questions, isn't it, Tom?
Well, arming yourself with the knowledge that there are payment arrangements in financial services that uh, contingent on the product being sold or whatever have you, means that you're in a better position to grill the advisor rather than the advisor steamrolling you. And that, I think, is a very important principle. In the same way with tax matters, or things that have tax implications, like that SMSF case in the Hayne Royal Commission, where the
Mm.
couple had
The B and
wanted to
B.
do a wanted to do a bread and breakfast deal, and they were not told by people until late in the piece that an SMSF has got to have a sole purpose, and that sole purpose is to help you invest for your retirement, not to help you have a property in which you live and run a business.
Well,
That's That's
Yes.
one of that was one of the issues in that case study. Had they gone to a taxation to look at the tax consequences, they would no doubt have been persuaded out of that particular line of thought. But
Yeah,
that's
that's
just one.
exactly right, Tom. And it's the same thing that, as I said, if you're looking at taking out a mortgage for an investment property, talk to your tax agent. Don't get tax advice from your mortgage broker or your relationship manager at the bank. Exactly the same that you don't take advice from someone that's trying to sell you a car at the end of financial year. So just remember,
Well, I mean,
everyone's got to play to their expertise.
yeah, there's that. I mean, it's a bit like the debate on COVID-19 at the moment, where you got a whole bunch of people who are economics commentators, and general commentators on politics and social affairs, telling you what COVID is going to do or not do, or what medication the government ought to allow people to have. When I've gone to a GP or a specialist, I haven't seen somebody with journalistic qualifications or a career in 30 years in journalism. I've seen people who've spent a heck of a lot of time mastering the art of medicine. Um, so look for expertise and look for knowledge rather than profile and smooth talk. If we've dealt with the individual side of life,
Hmm.
which is all very well and good, but we've probably got a few people who need some insight into where the business uh, deductions of interest might come into play.
Yeah, Tom. Well, it's a lot more complex. As I was trying to allude to with the individuals, it depends on what sort of the loan is for the investment property. With businesses, there's a lot more scope, flexibility, if you want to call it that, with what interest is deductible. So with there's some very classic tax law cases that gets taught at undergrad tax courses about when interest would be deductible for business. And there is also so normal business loan and normal business overdraft using business as usual. Of course, that's going to be deductible. You've got to look at holidays from interest repayments and things like that for businesses as well. Are they actually still on foot? So, therefore, can you take the deduction on an accruals basis or not? So, that's one thing we need to be aware of with COVID. But also for businesses, if you've taken out a loan for something that hasn't actually eventuated into a business, sometimes that can still be deductible, even though for an individual it would be too soon and not deductible. For a business, undertaking some feasibility studies or incurring some loan to establish a business that never really took off or never really became a business, that can be deductible. And then conversely, at the end of the business, say you've unfortunately had some bad luck and the business was sold and you were still holding a lovely loan against that business, then going forward, you can still deduct that interest as you're paying that off, even though the business is now not around anymore. So, as you can see, there's a lot more flexibility along the timeline of interest deductibility when it comes to businesses.
Yeah, that's actually quite interesting because it illustrates that dichotomy between individual and business.
Hmm.
And that's something that people need to bear in mind when they're grappling with it. Again, though, the business owner, irrespective of whether it's a small business or something a bit larger, needs to be careful of what they're committing to, and how the advice that they seek plays out and who they talk to about it.
Yeah, exactly, Tom. It's as we were saying before, it's very important to get the right advice from the right expert. And there's different, and it's not just from banks for business as well. You've got different lines of credit, and there's all different types of products available as well. When you look at it, even sort of the selling off of debt could be a way that you may consider it a bit like an interest deductibility sort of issue. So factoring of debt is very big in business, because really when we talk about business, we're really talking about cash flow most of the time. For businesses, I know COVID's sort of throwing a little bit of a spanner in the works of how we traditionally look at business models, but still, it's still the fundamentals that you've got to manage your cash flow, and one of those elements of cash flow is the payment of debt, whatever that is, whether it's interest deductibility or factoring of your accounts receivables or whatever. It still comes into play on how you're going to purchase the next bit of stock of inventory, so you can then sell it to then keep the cash flow moving through as we need to in most businesses.
I think that's quite a nice way to wrap up that part of the segment. There's a couple of other things that are probably worthwhile us touching on, and that is we are in the middle of September. But yes, Lisa and I are Victorians, but we're not talking about the fact that we feel aggrieved that Anastasia Palaszczuk has got the grand final this year. Um,
Please don't talk about that, Tom. I'm a St Kilda supporter, for the listeners out there that don't know. And I on Facebook came up. There's 5 St Kilda jumpers all signed that you can potentially win, right, from the St Kilda Footy Club. And I basically wrote there. I said Moorabbin, which is the home ground, of course, of St Kilda Football Club. I'm within the 5 kilometre radius for the Moorabbin footy ground, but the Gabba, I am not.
yeah,
So I hope that wins me a St Kilda signed footy jumper, Tom. But we'll see how it goes. I've missed out on seeing the boys around the local coffee shops and things like that as well. So, but then this year we're doing well, but probably next year, when hopefully everything's back to normal, we can start seeing a little bit more fruits of good old Britty Ratton and what he's doing with the boys. It's fantastic.
yeah. I think the other thing about the middle of September, aside from Victoria that are grieving a bit that the grand finals not going to be held down here,
We still get a holiday, but anyway, continue on, Tom.
eh, still get a holiday. Yeah, well,
That's a whole nother ball game. Continue on with your story. I've got
but
you sidetracked. Apologies.
just hold on a second. It's not much good having a day off when you can only stay at home. By the way, but that yeah, you know
Well, it's
that's
like the
just
23rd of October or something now. It's moved from when the grand final was, which is like the second or something. I think it's moved down to the Friday before grand final day, which is Cox Plate Day as well down here. For those of you that like the punt as well. So
but
hopefully by then we might have a few less restrictions, Tom. I don't know. We'll just fingers and toes crossed
well,
that
but we,
our
we,
numbers
we,
do come
we, we
down.
already know that people's pets are going to be able to get a haircut before their owners. So there we are.
Yeah. My
Uh,
poodle parlour for my four-legged sister doesn't do foils, unfortunately, so I'm still going to be grey.
well, there you go. The other thing that is probably worthwhile touching on, which is somewhat less frivolous and less amusing, is that around about mid September, people have got 6 weeks left if they don't use the tax agent to get their tax return in.
Yes.
So, having a look, just a reminder to people, if you're not using a tax agent, you're listening to this podcast, we've spoken a lot about when people should be getting their tax paperwork in, um, and you're coming to, you're heading towards the end of October. Please remember that if you're not using a tax agent, there's a requirement to get all that finalised for the 2019-20 financial year by the end of October. However, if you are using somebody like Lisa, um, you have until the following May. It's the
Correct, Tom.
first week. It's the first week of May. So if you've got
No,
a
it's actually the 17th of May this year. It's usually the 15th, but the 15th falls on a weekend. So we've got till the 17th of May. So if you
2021, yeah.
Yeah. Yeah, 2021. Yeah. Oh, that sounds awfully a long time away, doesn't it? So the rule of
It
thumb
does.
is if the ATO owe you money, get it done quickly. If you owe the ATO money, leave it till the 17th of May to lodge, because then you've got to let it process and then you don't have to pay your debtor for another 21 days after your notice of assessment is given. So that's sort of then pushing it nicely into late June, probably. So that's what
There's
you can
that,
do to
but
manage your own cash flow.
yeah, it's one way of managing cash flow, but also speaks to the advantage of using a tax agent. I think the important thing for people to remember, all jokes aside, is that you're coming close to the deadline, and get things organised, get things sorted. Um, if you're looking for a tax agent, it's still not too late to ring people up to help you out with any thorny issues or with lodgement itself.
Yes,
But
the
you
rule
know,
of thumb is if you want to have the extended concession of using a tax agent, you've got to basically get on our list, as we call it, by the 31st of October. So if you contact,
so how does somebody get on a tax agent's list? How does that work?
just basically contact us and agree that sign some sort of engagement letter or documentation to the effect of saying yes, I will let Lisa be my tax agent, and then what I do is I do the necessary back end paperwork with the ATO through the ATO portal to basically put this person on my list, and then their due date for their 2020 tax return goes from the 31st of October, which actually I think it's the 2nd of November because it's a weekend as well, from the 2nd of November, and then pushes it out to the 17th of May. So the ATO are not going to go chasing you and saying, where's your tax return, if that's the case. But you can't decide like at Christmas going, oh, I haven't done my tax return, I better go on Lisa's list, right? That sort of doesn't help you. It means your tax return is still late. And then we need to do a little bit more shuffling to explain to the ATO that we've just recently been appointed. So it's still not a fait accompli that you'll get a black mark against your name for having a late tax return, Tom. But it's better if you do it by the 31st of October because it sort of just happens automatically that way.
Yeah, I think that's a useful thing for people to know. We're expecting the federal budget reasonably soon as well.
Yeah, 6th of
Independent,
October. Yeah.
yeah. There's not a lot that's being kicked around of great significance, as far as I can tell.
Yeah,
Um,
they're talking still about tax cuts, Tom. So we'll just wait. But as we know, when we come up to budget time, there's always leaks to sort of do a little bit of a water cooler pub test, laugh test to see whether what's the appetite for the Gen Pop to accept the changes. But I don't look. It's not going to be anything radical. We're still in the midst of COVID, whether it's things that are happening in New South Wales, WA, South Australia, Queensland, or in lockdown Melbourne. Everyone's still feeling the pinch.
I
So
think
while
yeah, it'll
borders
be
are closed, I don't think there's going to be anything too controversial coming through in a Josh Frydenberg last Matthias Cormann budget.
Yeah, I don't think they'll be talking about Back in Black this time around somehow. But the other thing that we spoke about, I think the other last podcast, is also the FBT issue and small business, and that it'll be interesting to see whether that issue gets picked up.
Yeah, it'd be really interesting because it's got a it's always been a tax that people haven't haven't really liked because the compliance costs are so high, as we talked about last time, Tom. So that could be something which would stimulate um, the hospitality area as well. So as I said, as we talked about last time, could be good for all sides. So we'll see how that occurs. But as I said, it's not going to be revolutionary tax reform, anything like that. Anyone who's aware of Division 7A, that's been pretty much put on hold. Any of those amendments that's been talked about over the past 3 or 4 years. Uh, those of you that follow tax reform in this country, we don't do it very quickly, and we don't do it. We don't break the model to fix it again. We just keep adding more blocks on top of the
Well,
pyramid,
we
and
don't
hopefully it holds together.
we don't even do it well, let alone quickly. I mean, if we can uh,
Yeah.
thump the thump the barrel a bit more here, you've got a situation where back in the mid 90s, somebody thought it was a good idea to attempt to simplify the tax legislation, and we had a little thing called the Tax Law Improvement Project,
Mm-hmm.
and the people in Treasury did the consultation and all that stuff, and just like a self-made man, I guess we ended up with a job half done. We've still got the 36 Act, and we've got an act that was put in 1997, and you've got practitioners who've got to straddle different language and all the other interpretative issues that exist in that space. It has been appalling.
Yes.
Well,
Nothing
yeah,
more to add
it's been
than yes, Tom.
it's
That's
been
what we have to
appalling.
deal
I mean,
with.
I remember seeing the exposure drafts. It was amongst the first tax issues I dealt with when I began exploring tax and accounting in the mid 90s, when I was considerably younger and had less grey hair. But
Don't talk about grey hair at the moment. Yes, continue.
okay, fine. Apologies, but the those exposure drafts attempted to convert the tax law into plainer English,
Mm-hmm.
and it would have been nice if people finished the process properly, so the tax law is complete. But then we had the introduction of the GST, which sort of came in, but where the Democrats managed to get the exemption on a whole bunch of stuff. So that then meant that system was not as pure as people who were advocating for it would have liked.
Yeah, but
And then
one
there
good
were
thing about ants, as I call it, well, that's what it's called, not the GST Act, unfortunately. It's ants, a new tax system. I always think that's quite funny. But anyway,
yep,
at least at least it's written in plainer English. But then it's just got that complex with what we have as GST free and input tax, and it's just our whole tax system is more complicated than it needs to be, as we know, Tom. And
yeah,
people may laugh and say it keeps me in a job, but like it just makes it too hard. And then every single change, like all the COVID stimulus packages, just is the straw that breaks the camel's back, and all of us are just sort of a bit over it at the moment. So we just do what we can.
yep, and in just to flag the people tuning into this, in future podcasts, we've got some other tax podcasts. That is, we will be talking a bit more about some of the administrative issues that people are having with the tax office. Because I've been picking up on some intelligence about some ridiculous situations that have been evolving in recent times. Some of them are errors, and some of them might be more deliberate things that are going on. But we'll explore that, and we'll try and we'll try and help the listeners work their way through um, issues they may have with the tax office using some of those case studies. Okay, Lisa, that's probably a wrap for this week's podcast. Uh, is there anything else that you want to point to?
No, Tom, I'm just sort of waiting on just the finer details of JobKeeper to come through. I was hoping that was going to come through yesterday, as usually Friday's the announcement day for JobKeeper. So we're still waiting on a couple of little bits of.
So the ATO, whoever is responsible for taking the wheelie bin out and depositing the garbage on tax agents' desks on a Friday at the ATO didn't do
Yeah,
their job yesterday.
No, I was sort of half expecting it because there's a lot of software vendors and things like that doing webinars next week on what's happening. And of course, these software vendors need to know more information earlier so they can update all their software, especially their payroll software for JobKeeper changes. So we're just waiting and seeing what's happening, just really checking on the comparative of the 30% downturn, whether we can use, do we have to use how we report in our BAS, or can we still have the option between accruals and cash basis, and also the alternative test. And there's a lot of my clients who are just going, Lisa, does that mean that we've got our JobKeeper rates dropping uh, next month? And I said, well, at this stage, correct. And the other thing that's hurting them is that if they happen to be, say, they're a business owner, and they only working 20 hours in the business for the month of 20 hours a week in the business for the month of February. Well, they're then cutting their JobKeeper not from 1,500 to 1,200, but from 1,500 down at 2,750. So it is causing a little bit of grief at this stage, but we'll just see how things go, especially for us Victorians.
Yep, it'll be interesting to watch. Okay, Lisa, thanks for joining me again this week, and we'll catch up with the listeners uh, late next week. I think is probably when we'll do the next one. Okay, thanks for that.
My pleasure, Tom. Have a great evening.
And to the listeners, stay safe, look after each other. And if you're in Melbourne, you're in curfew at the time we recorded this, so you're probably not going anywhere. Thanks for tuning in.